Hey everyone, welcome back to another video. I hope you're all doing well and having a great day. Let's dive right in. Jack Dorsey is making headlines today, one of the founders of Twitter, who's been vocal about his mission to bring Bitcoin to the masses since 2018. He envisions Bitcoin as the currency of the future, believing we'll exclusively use it for transactions. Interestingly, many others in the space seem to be converging on similar predictions for Bitcoin's future value. For instance, Jack Dorsey predicts it could hit $1 million per coin by 2030, while Kathy would suggest even higher numbers due to factors like ETFs, potentially reaching $3.8 million per coin. Such projections imply a seismic shift in the global financial landscape, with Bitcoin surpassing gold as the largest asset class. This indicates a future where Bitcoin is ubiquitous, accepted everywhere for any transaction. Exciting times ahead, as Bitcoin's value skyrockets to $3, $4, $5, or even $10 million, it's becoming the go-to currency for stock trading and other transactions, effectively replacing traditional currencies like the US dollar. People are selling off other assets to invest in Bitcoin, anticipating its continued appreciation. With Bitcoin's value increasing every 4 years, no one wants to miss out on the opportunity. Looking ahead to 2030 to 2032, projections suggest even more exponential growth, with some predicting a $50 million plus valuation for Bitcoin by 2040. This deflationary nature means everything else loses value in comparison, leading to a Bitcoin-dominated investment landscape. It's fascinating to see such widespread optimism and confidence in Bitcoin's future, especially considering the consistent predictions of its astronomical growth from various sources. Despite occasional price swings, there's a strong trend of accumulation, with whales consistently buying in. Unfortunately, many newcomers to the market end up selling during these cycles, missing out on the potential wealth transformation Bitcoin offers. The prospect of a $1 million Bitcoin within the next 5.5 years is truly staggering, promising profound changes to finance and personal wealth. Let's keep an eye on how this unfolds. Binance, the world's largest crypto exchange, has recently disclosed reserve numbers across the top 5 digital assets by market cap, despite a recent slump in prices. It's important to note that such disclosures are crucial regardless of market fluctuations. Reflecting on past incidents like the FTX collapse, where concerns arose due to lack of proof of funds, it's evident why transparency is paramount in the crypto space. Back then, rumors swirled about FTX's financial instability, but later, it was revealed that their funds were frozen by regulatory authorities. This highlights the need for exchanges to maintain transparency and accountability. Just recently, there were reports that individuals owed money by FTX might finally receive their dues. However, these developments often don't receive widespread attention, even though they have significant implications for users and the crypto community at large. It's fascinating to see how crypto exchanges have evolved in terms of transparency, especially following incidents like the FTX collapse. Many exchanges, in response to these events, committed to regular disclosures of their reserves to instill trust among users. This move towards transparency was welcomed by the community, aligning with the ethos of crypto being decentralized and transparent. However, despite initial enthusiasm, the practice seemed to lose momentum over time, with fewer exchanges actively participating in such disclosures. This highlights the challenges inherent in maintaining transparency within the crypto space and underscores the ongoing need for vigilance and accountability from exchanges to ensure the security of users' funds. Binance deserves credit for maintaining transparency despite criticism. Their consistent release of proof of reserves, now on their 18th report, sets them apart as the most transparent exchange in the crypto space. While other exchanges have ceased providing this vital information, Binance continues to demonstrate accountability by ensuring their reserves cover users' assets one-to-one, with an additional buffer. In their latest report, Binance disclosed excess backing of at least 104% for major assets like Bitcoin, Ethereum, Tether, Binance Coin, and Solana. This level of transparency is crucial for instilling trust among users, reassuring them that their funds are secure even in extreme scenarios. The phenomenon of lost bitcoins, once a common occurrence in the early days of crypto, has significantly diminished over time. In the past, when Bitcoin was relatively unknown and inexpensive, it was easy to overlook or forget about small holdings. However, with increased awareness and attention to crypto prices, the likelihood of losing coins has decreased drastically. Nowadays, anyone involved in crypto, especially newcomers, tends to be more vigilant about monitoring their holdings. Additionally, collaborations like the Decentralized Recovery Direct Alliance, DRD, aim to address the issue of lost coins by providing solutions for those who may struggle with self-custody. While self-custody solutions like cold wallets are not suitable for everyone, storing coins on reputable exchanges is a valid option for many users. It's essential for individuals to feel comfortable asking questions about the safety and security of their funds on exchanges, as they are paying for a service and deserve peace of mind. Breaking the stigma around discussing financial matters can lead to better informed decisions and increased confidence in managing crypto assets. Adoption of digital assets. Ensuring the safety and security of these assets becomes increasingly crucial. That's why it's essential for users to ask tough questions to crypto exchanges about the safety measures in place, such as reimbursement policies in case of system failures or security breaches. This collaboration among various entities, including the Algorand Foundation and Swirled Labs, to form the Decentralized Recovery Alliance, signifies a proactive approach to address the challenges associated with self-custody of digital assets. By providing an open-source process for recovering lost assets and establishing governance structures, the Alliance aims to streamline and accelerate the recovery process. Founding members, like Ripple and XRP Labs, play a vital role in shaping the direction of the Alliance and ensuring that user interests are prioritized. As digital assets continue to gain traction among the masses, initiatives like these are crucial for fostering trust and confidence in the crypto ecosystem. It's interesting to see Ripple, XRP Labs, Hadera, and the Algorand Foundation collaborating to address the issue of lost crypto assets through the Decentralized Recovery Alliance, DRA. While the specifics of their approach haven't been disclosed yet, it's encouraging to see efforts being made in this direction, especially considering the increasing adoption of digital assets. As for Tether, its rise to prominence in the crypto space has been accompanied by persistent scrutiny and allegations of corruption. Despite its widespread use, Tether has faced accusations of not having the necessary reserves to back its value, leading to doubts about its solvency. Recent criticism from Deutsche Bank further underscores the contentious nature of stablecoins and the competition they pose to traditional financial institutions. With the immense volume of transactions involving stablecoins, there's a significant stake for banks and other entities looking to enter this space. However, attempts to discredit Tether through media reports and questioning its sustainability may be driven by ulterior motives, such as promoting alternative stablecoins backed by traditional financial institutions. It's essential for investors to critically evaluate such narratives and consider the broader context of the crypto market dynamics. You're absolutely right in questioning the motives behind the scrutiny Tether faces, especially considering its widespread adoption by crypto exchanges. It's highly improbable that all these exchanges would list Tether without conducting thorough due diligence on its reserves. Deutsche Bank's research paper, while citing historical data on currency pegs, may not accurately reflect the stability of stablecoins, especially considering the evolving landscape of digital assets. The timing of FTX's scrutiny and subsequent collapse, along with the sudden decrease in acquisition valuations for crypto companies, raises suspicions of coordinated efforts to manipulate the market. It's essential for investors to critically analyze such narratives and consider the broader context of the crypto industry's dynamics and vested interests.